Right now, as you watch this video, silver is being pulled out of New York vaults at a pace this market has never seen before. Not in 2008, not in 2011, not ever. On February 11, 2026, official COMEX data confirmed that registered silver dropped below 100 million ounces in a single day. Over 3.2 million ounces gone in one day. And while that was happening in New York, buyers in Shanghai were paying $9 above the Western spot price just to get their hands on real metal. This is not a prediction. This is not a theory. This is happening right now. And by the end of this video, you will understand exactly what it means for your money. Let's start with the numbers, because the numbers tell a story that most people on Wall Street do not want you to read. In October 2025, COMEX registered silver sat at 167.7 million ounces. That is the silver in New York vaults officially available to be delivered against futures contracts. By February 5, 2026, that number had fallen to 103.5 million ounces. Then on February 11th, it dropped below 100 million ounces after a single-day adjustment of 3.2 million ounces. That is a 38% decline in just over 3 months. Now here is the part that matters. Every single day in January and February 2026, silver has been leaving these vaults at a rate of approximately 785,000 ounces per day. Not slowing down, not reversing, just leaving. Every single day. COMEX recorded 14 straight days of outflows, the longest continuous drawdown streak in nearly a decade. One single day saw 3 million ounces, which is 95 tons, shipped out of those vaults. Think about what 95 tons looks like. That is not traders clicking buttons on a screen. That is trucks, logistics, and real physical weight moving from one location to another. That is actual metal leaving the building. Now you might be asking, why does this matter so much? Because COMEX is not just a place where people bet on silver prices. It is the foundation of how silver is priced for the entire Western world. The price you see quoted on your phone right now, that number comes from COMEX futures. And COMEX futures are supposed to be backed by real physical metal sitting in those New York vaults. When the metal in the vaults disappears, the relationship between the paper price and the real physical price starts to break. And right now, that break is already happening. In Shanghai, physical silver is trading at a premium of around $9 above Western spot prices. That gap is the market telling you something. It is saying that real metal is worth more than what the paper price reflects. Here is what makes this different from every other silver story you have heard. Previous drawdowns in COMEX history were smaller and shorter. In 2011, when silver hit $50 per ounce, inventory dropped around 30% and then bounced back. During the 2020 pandemic, there was a brief dip. This time is different. Since 2021, COMEX registered silver has declined over 70% from its peak with no reversal in sight. The decline has continued through multiple years, multiple price levels, and multiple market conditions. That persistence is the signal. Markets that are functioning normally do not drain in one direction for years without stopping, and the drain is not coming from retail investors pulling out small amounts. The first CME delivery report of 2026 showed JPMorgan, the largest bank in the United States, aggressively standing for maximum physical delivery. JPMorgan, the same bank that paid a record $920 million fine in 2020 for manipulating the precious metals futures market. They are not rolling their contracts forward anymore. They are taking the silver out of the vault. When the institution that knows this market better than anyone else starts pulling physical metal instead of playing the paper game, that is a data point you do not ignore. The vaults are draining. The institutions are moving. And this is only part one of the story. China is not buying silver. China is taking silver. And there is a very important difference between those two things. Since January 1st, 2026, China has put restrictions into effect that limit how much silver can be exported out of the country. Only 44 companies received authorization to export silver during 2026 and 2027. Those 44 companies control approximately 121 million ounces of annual exports. That number represents 60 to 70% of the refined silver traded globally every single year. Read that again. China controls 60 to 70% of the world's refined silver trade, and they just turned the tap down. But here is what makes this even more significant. While China restricted exports, domestic Chinese buyers did not slow down. They accelerated. Shanghai buyers are paying a $9 premium over Western spot prices because they understand something that most Western investors have not fully processed yet. Physical silver is becoming genuinely scarce, and they want to secure it before the price reflects that reality. The $9 premium is not just a number, it is evidence of a market splitting in two. On one side, you have the Western paper price, the COMEX futures number that gets quoted everywhere. On the other side, you have the real physical price, what buyers in Asia are actually paying to get metal in their hands today. These two prices are supposed to stay close together. When they diverge, it signals that physical supply and paper supply are telling completely different stories. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They were a massive net exporter. Now they have restricted that outflow. The metal they were sending to Western markets has slowed dramatically. That means the global supply pipeline that Western industrial users depend on just got significantly tighter overnight. And the scale of China's control over this market is something most people in the West have never stopped to calculate. Chinese refineries control an estimated 2/3 of the world's fresh silver bar production. That is the mined silver that gets processed and turned into the 1,000-ounce bars that COMEX vaults and industrial manufacturers actually use. If China limits that output, the Western market has no quick replacement. New mines take 8 to 12 years to develop from discovery to production. Recycling has been flat for years. There is no emergency supply switch to flip. This is not a trade dispute that gets resolved in a meeting. This is a structural shift in how silver flows around the world. And New York is at the end of that supply chain. What most people miss is that China's own domestic demand is the reason behind this policy. China's solar panel manufacturing alone consumes hundreds of millions of ounces of silver per year. Their electric vehicle industry is growing. Their electronics manufacturing is the largest in the world. They are not restricting exports to hurt Western markets. They are restricting exports because they need the metal for themselves. That changes the calculation entirely. This is not a temporary export restriction that gets reversed when trade tensions ease. This is a country securing its own industrial future. The silver that was flowing out to New York is now staying in Shanghai. Samsung saw this coming. The company recently finalized a deal to lock up 100% of the silver output from a Mexican mine for 2 years through a direct prepayment arrangement. They did not go to COMEX. They went directly to the mine. Because they understand that if you wait for the open market to supply you, the open market may not have what you need. When the largest technology manufacturers in the world start bypassing exchanges entirely to secure their own private supply, the signal is clear. The normal supply system is under stress, and the $9 Shanghai premium is the price tag on that stress. Here is where the receipts are. Not opinions, not forecasts. Official CME data. As of February 5, 2026, COMEX March 2026 contracts had 429 million ounces of open interest. That is the total amount of silver bought and sold in paper form for March delivery. Against that, registered silver inventory stood at 103.5 million ounces and falling at 785,000 ounces per day. Do the math. By the time March 1st notice day arrives on February 27th, available inventory could be down to approximately 85 million ounces, so you have 429 million ounces of paper claims, against roughly 85 million ounces of real metal. If even 25% of March contracts stand for physical delivery, that is 107 million ounces of demand against 85 million ounces of supply. The numbers do not work, and here is what makes that scenario very realistic. The delivery rate so far in 2026 has not been 25%. In February 2026, 98% of contracts that could request delivery did request delivery. Not 25%, not 50%, 98%. In January 2026, total COMEX silver deliveries hit 49.4 million ounces, 7.27 times higher than the same month in 2024. Total deliveries for all of 2025 were 474 million ounces, which was double the 474 million from 2024. When 98% of futures contracts stand for delivery instead of rolling forward, the market has changed its function. It is no longer a betting market where people trade paper back and forth. It has become a physical allocation mechanism. People are not speculating on the price of silver going up or down. They are using the futures market as a way to get actual metal out of the vault and into their possession. That is an extraordinary development. The futures market was built for price discovery and risk management. It was not designed to be a silver pickup window, but that is what it has become. COMEX registered silver fell from 167.7 million ounces in October 2025 to below 100 million ounces by February 11, 2026. That is a 38% decline in roughly 3 months. At the current drainage rate of 785,000 ounces per day, the system has limited runway before March delivery demand hits. The people watching this data most closely are not retail investors. They are the institutions and banks who operate inside the system. And what those institutions are doing right now is standing for delivery. They are taking the physical metal out. JPMorgan is at the front of that line. When the largest market participant moves from paper to physical, it is not a small signal. It is the clearest signal the market can send. March 27 is the first notice day for April delivery. Between now and then, every day of continued outflow reduces the available buffer further. The math is not comfortable. Let's step back and look at the full picture, because that is what serious investors do. They do not react to single headlines. They read the system. The system right now is showing you several things at the same time, and they all point in the same direction. The global silver market has been in deficit for 5 consecutive years, starting in 2021. The cumulative shortfall from 2021 through 2025 is estimated at 820 million ounces. That number is roughly equivalent to an entire year of global mine production, gone from above-ground inventories. Those missing ounces came from exchange vaults, from bank storage, from private hoards. That reservoir has been drawn down steadily and has not been replenished. Industrial demand is not going away. In 2025, global silver demand reached an estimated 1.24 billion ounces. Total supply, including mining and recycling, came in at approximately 1.01 billion ounces. That is a deficit of over 230 million ounces in a single year, roughly equal to the entire annual production of Mexico, the world's largest silver producer. Solar panels, electric vehicles, data centers, semiconductors, all of these applications use silver. None of them can substitute it easily or quickly. Silver lease rates hit 8% annualized in January 2026. Normal lease rates are 0.3 to 0.5%. An 8% lease rate means institutions are paying enormous premiums just to borrow silver so they can guarantee delivery on contracts. That does not happen in a market with healthy physical supply. It happens when real metal is genuinely hard to find. Now connect all of this together. 5 years of structural deficit drawing down inventories. COMEX vaults losing 38% of registered silver in 3 months. China restricting exports of 60 to 70% of global refined silver trade. Shanghai buyers paying $9 over spot. Lease rates at 8%. JPMorgan standing for maximum physical delivery. Samsung locking up mine output directly for 2 years. Each of these data points on its own is notable. Together, they describe a single coherent picture. The paper silver market and the physical silver market are operating on different realities right now. The paper price reflects what futures traders believe about the future. The physical premium in Shanghai reflects what buyers who need actual metal today are willing to pay to get it. That gap, that $9 premium, is the distance between the two realities. And based on everything the data shows, that gap has not peaked. For a serious investor, this is not about chasing a price spike. It is about understanding a structural shift before the broader market fully prices it in. The COMEX data is public.
The CME delivery reports are public. The Shanghai premium is visible. The lease rates are reported. None of this information is hidden, but connecting it requires looking at multiple data sources simultaneously and filtering out the noise. That is what this analysis is for. No predictions, no price targets, just the receipts. The vaults are draining. China is restricting supply. Banks are taking physical delivery. The March math is tight. These are not opinions. These are documented facts from official exchange reports and publicly available market data. What you do with this information is your decision, but now you have it.